This year, a handful of technology companies will spend at least $640 billion building AI infrastructure, data centers, chips, and the power to run them. And that's the conservative count. That is more than the annual economic output of most countries on Earth, spent in a single year by fewer than 10 companies on an industry in which almost no one is actually making a profit. That gap between the biggest infrastructure spend in the history of private enterprise and an industry that loses money on nearly every customer is the most important story in technology right now. Not the demos, not the doomsaying, the math. So let's do the math slowly and then work out the 3 ways this can possibly end, because one of them directly involves your wallet. First, get the scale right, because billions has stopped meaning anything. In 2025, the big cloud and AI companies, Microsoft, Google, Amazon, Meta, and their peers, spent roughly $400 billion on capital expenditure, most of it AI-driven. For 2026, the plans they announced coming into the year total somewhere between $600 and $700 billion, depending on who's counting and which companies you include. Call it $640 billion, and treat that as a floor, not a forecast. By the middle of this year, the same company's own guidance had already pushed the total toward $800 billion, because these numbers get revised in exactly one direction, with almost comedic regularity. For scale, the Apollo program, the entire Put Humans on the Moon project, cost about $300 billion in today's dollars, spread across more than a decade. The AI industry is now spending roughly 2 Apollo programs per year and accelerating. Analysts expect the multi-year total to cross $1 trillion within a couple of years. Where does it physically go? 3 places. Specialized AI chips that cost as much as a luxury car each and are bought by the hundreds of thousands. Warehouse-scale data centers to house them. And electricity, enough that AI companies have started signing deals for their own power plants, which is the kind of detail that tells you a technology story has become an infrastructure story. Now the revenue side, and this is where the vertigo starts. All of that spending exists to serve an industry, AI models and the products on top of them, whose actual sales are a small fraction of the build-out. Take the flagship. OpenAI, maker of ChatGPT, reportedly booked around $13 billion in revenue in 2025, a spectacular number for a company so young. Against that, reporting on its financials describes an operating loss of roughly $20 billion in the same year. Read that again. The loss was larger than the revenue, and the company itself has signaled it expects to keep losing money for years before profitability. Its rivals are on the same treadmill in different lanes, some burning less, all burning, while revenue across the industry, though growing genuinely fast, remains an order of magnitude smaller than the infrastructure being built to serve it. If you watched our earlier video about why AI companies lose money on your $20 subscription, this is that exact mechanism at civilization scale. Every AI answer costs real money in chips and electricity, software with factory economics. Normal software gets cheap at scale. AI's serving costs grow with every user. The more successful the product, the bigger the bill. That's how a company can double its revenue and lose more money than last year. And it's why the industry's total losses rise in lockstep with its total success. So why would the smartest, richest companies on Earth sign up for this? Not mass delusion. There's a real argument, and you should hear its strongest version. First, the demand is genuine. Hundreds of millions of people use these tools weekly. Businesses pay real money for them. This is not an imaginary product searching for a use. Usage keeps embarrassing every forecast in the upward direction. Second, costs fall. The price of processing a given AI workload has collapsed year over year. Better chips, more efficient models. The bet is that today's loss-making service becomes tomorrow's profitable one, while prices hold still. We covered that racing dynamic in the subscription video. Falling costs versus rising usage. Both lines moving fast. Third, and this is the one that actually explains the spending. They believe this is a winner-take-most platform war, like search and smartphones before it. If AI becomes the next layer of all computing, the companies that own the infrastructure collect rent for decades, and underspending is fatal in a way overspending is not. Miss the build-out and you become the cautionary tale. The search engines before Google, the phone giants before the iPhone. When those are the stakes, the rational move for each individual player is to spend like this. Keep that phrasing in mind, each individual player, because it's exactly how bubbles are built by smart people. And there's a fourth force, less flattering and just as real. Nobody gets fired for spending during a gold rush. A chief executive who overspends on AI and is wrong loses margin. One who underspends and is wrong loses the company and gets remembered as the person who watched the future happen from the sidelines. Boards, markets, and headlines all currently punish caution harder than excess, so the checks keep getting bigger even in boardrooms with private doubts. Individually rational, collectively heedless. Write that on a card because it's the recurring signature of every capital bubble in history, and its presence here doesn't prove this is one, but its absence would have been more reassuring. Here's where history has something rude to say. We have run this experiment before. In the 1800s, railroad companies raced to blanket continents with track. Transformative technology, insatiable demand, limitless-looking future. They overbuilt catastrophically, and waves of railroads went bankrupt. In the 1990s, telecom companies buried millions of miles of fiber optic cable for an internet that was absolutely real and absolutely could not yet pay for it. Many collapsed, and in both cases, the infrastructure survived its builders. Cheap rail and cheap fiber powered decades of growth for other people. The pattern repeats because it's not stupidity, it's structure. When everyone must build to survive the race, the industry in aggregate overbuilds, even if every individual decision was defensible. But AI adds a twist the railroads never faced. The infrastructure rots. Track lasts a century, fiber, decades. An AI chip is state-of-the-art for only a few years before newer chips make it uneconomical to run. A massive share of this $640 billion build-out is spending on assets with the shelf life of a laptop. The railroads overbuilt things that lasted. This industry may be overbuilding things that expire, which means it can't wait patiently for demand to catch up. It has to be right soon. And one more wrinkle straight from the late 90s playbook. The money is getting circular. Chip makers investing in AI labs who spend the money on chips. Cloud providers funding startups who spend it on cloud. Revenue that loops between the players of one small circle is real cash, but it makes the demand picture look healthier than it might be. That exact pattern showed up in the year 2000, right before the telecom crash. It doesn't prove anything. It's just the kind of detail historians later circle in red. So how does a $640 billion problem resolve? 3 ways, and reality will be some blend. Ending 1, they grow into it. AI revenue keeps compounding, costs keep collapsing, enterprises keep signing, and in a few years the build-out looks like Amazon's money-losing years. Reckless right up until it was genius. This is the ending the spending assumes. It requires the growth curves to keep behaving, the chips to stay useful long enough, and businesses to keep finding real productivity in these tools. Possible, genuinely possible. Ending 2, the customer pays. If profits won't come from scale alone, prices rise to meet costs. Subscriptions creep up, usage gets capped and tiered, free products fill with ads, enterprise contracts get squeezed. The industry becomes profitable the boring way, by charging what things cost. Less apocalypse, more airline industry. Ending 3, the correction. Growth disappoints, Funding tightens, and the weakest players fold or get absorbed. The overbuilt capacity floods the market, AI compute gets absurdly cheap, and here's the historical rhyme. The next decade of winners gets built on the discounted wreckage, the way the modern internet was built on bargain fiber from bankrupt telecoms. Ugly for investors, oddly great for everyone downstream. Notice what's not on the list. AI quietly disappearing. The technology works and the demand is real. That part is settled. The $640 billion question was never whether AI matters. It's who ends up holding the bill for its infrastructure, shareholders, customers, or the bankruptcy courts. Bring it down to your desk, because every ending routes through your wallet eventually. If you use AI, today's prices are the promotional period. Whichever ending we get, the subsidized flat rate buffet, the $20 plan we dissected before, is a wartime price and wars end. Expect tighter caps, more tiers, more ads. Use the cheap years well, and don't let a workflow you depend on assume today's pricing forever. If you're building something on AI, price your product to survive your cost doubling. Per usage pricing survives every ending. Flat rate resale of someone else's subsidized model survives only ending one, and you don't get to vote on which ending occurs. And if you're watching the stock market with AI euphoria in it, no predictions here. That's not this channel. Just one filter. The companies selling the shovels, chips, power, infrastructure, get paid in every ending. The companies buying them get paid in one, maybe two. That asymmetry, not any forecast, is the actual lesson of the railroads. $640 billion a year, give or take, building the infrastructure for an industry that doesn't yet pay for itself. It is either the greatest act of foresight in business history or the largest bonfire of capital ever assembled. And the honest answer is that nobody knows yet, not the CEOs writing the checks, and certainly not anyone on the internet telling you they're sure. What you can know is the shape of the thing. Real technology, real demand, real costs, and a bill that someone, shareholder, customer, or court, must eventually pay. Watch the boring numbers, not the demos. Prices, caps, chip lifespans, and whether the revenue curves keep their promises. That's where this story will actually be decided. Nobody's running a charity, and the land grab, as we said once before, only makes sense if the land turns out to be worth it.